4 not so good things that happened on the way to doing my Roth conversion. So you've heard me talk about Roth conversions a lot on the channel here. And when we talk about Roth conversions, we're really just trying to understand a tax arbitrage situation. So if we think our tax rate today is going to be lower than what we think our tax rate might be in the future, then it's going to make sense for us to at least consider doing a Roth conversion. But as we're doing these Roth conversions and planning out our income, there's a few unexpected things that can sometimes be triggered by not only the Roth conversion, but also the ability to pay the taxes on that Roth conversion. And that's what I'm going to get into in today's video. So when we talk about paying the taxes on Roth conversions, there's really just two ways to do it. One way is to actually take the money from the IRA account itself. And this is something that a lot of people overlook. A lot of people just dismiss the idea of doing a Roth conversion because they don't have the money to pay the taxes. Well, you can actually take an extra withdrawal from your IRA account to pay the taxes on the Roth conversions, but you still want to stay in the tax bracket that you're targeting. So a quick example of this is, let's say you've identified that you have $100,000 in the bracket that you're trying to target, whether that's the 22% or the 12% or the 24%, and you don't have the money to pay the taxes. So you could do a $75,000 Roth conversion, moving the money from your traditional IRA to your Roth IRA account. And then if you're in a 25% tax bracket, just take an additional $25,000 distribution from your IRA account and use that to pay the taxes on the conversion. One very important thing, you're going to want to make sure that you're at least 59.5 to be able to do this, because if you're not, you could get hit, and you probably will get hit, with a 10% premature withdrawal penalty. Now, when you do the Roth conversion, you can be any age. As long as you're doing that Roth conversion from an IRA to a Roth IRA account, there are no premature penalties for that. But if you're taking the money out of the IRA account, that's something to definitely watch out for there. Most people, if you have the ability, are going to want to pay the taxes on the Roth conversion from a non-retirement account. And if you have the money just sitting in a bank account or a money market account, and it's in cash, you can just withdraw that money and use that to pay the taxes, and there wouldn't be any additional tax on the money that you're taking out to pay the taxes on the Roth conversion. A lot of people, though, are going to need to sell something to get the money to pay the taxes, and you're going to have to sell maybe a mutual fund or a stock or an ETF or whatever that may be, so sale of securities, and that's going to depend on whether or not it's a short-term capital gain or a long-term capital gain. If it's a short-term capital gain, it's going to get taxed at the ordinary income tax rate, the same as if you took that $25,000 out of your IRA account to pay the taxes. But if it's a long-term capital gain, or if you're getting money from dividends, let's say, it's going to be taxed at a better tax rate. It's going to be taxed at your preference tax rate. And so that's important to know, just as you're starting to take the money out to pay the taxes on these Roth conversions. Okay, so let's jump in and let's start talking about what are some of these unexpected things that could cost us more money as we're doing some of these Roth conversions. Well, the first one is going to be higher potential Medicare costs. So if you're 65 years or older and you're on Medicare, you probably know that there's a base rate for Medicare, but if you exceed certain thresholds, the cost for your Medicare premiums are going to go up. And if you hit higher brackets, it can really go up a lot, and it can even double or even over triple the amount you're paying for your Medicare benefits. So where are those thresholds here? Well, the first layer of thresholds start for single tax filers at $106,000 of modified adjusted gross income, and for those that are married filing joint, if your income, modified adjusted gross income, is over $212,000, you're going to hit that first tier of higher Medicare costs. So you may be targeting something like the 22% tax bracket, and you might say, hey, I've got all this extra room, but before you get to that top end of the 22% tax bracket, you're likely going to hit one of these Medicare thresholds that's going to cost more for your Medicare premiums. And how this works essentially is, if you do a Roth conversion or you take any amount of income in 2025 and you exceed that threshold, your Medicare premiums don't go up right away. There's actually a 2-year look back. So what you do here in 2025 is going to potentially affect the Medicare premiums you're going to pay in 2027. And that's how that works. If you end up having lower income in 2026 and it's not hitting one of those thresholds, well, then in 2028, those Medicare premiums will go back down to that base rate level. So what does that look like? Well, the base rate for Medicare in 2025 here is $174,070. per month. And the first tier of the increase, if you exceed that 106 or 212,000, if you're married filing joint, jumps up by a pretty good amount to $244.60. That's an extra $70 per month per person. So that'd be like $838 a year, or if you're married filing joint and you're exceeding that threshold and you're both on Medicare, it could be an extra $1,677. Probably not something that's going to totally, in most cases, dissuade you from doing that Roth conversion. It's still, in most cases, it's probably going to make sense to do the conversion, even though you might be paying a little bit more for Medicare. But it's one of those unexpected things that needs to be part of the equation as you're considering doing this Roth conversion. What are all of the things, not just the tax on the Roth conversion, but what are all of the things that are being triggered from that? And these Medicare premiums are one of the biggest ones that could potentially be impacted by doing that Roth conversion. The next one is going to be a new one. And I just did a video here earlier this afternoon where I talked about the new Senior Bonus Deduction that was part of the One Big Beautiful Bill Act. And for those that are 65 years or older in 2025 and all the way through 2028, you're going to get potentially an extra $6,000 per qualifying person as an extra deduction. That's going to be over and above your itemized deductions if you itemize, or it's even going to be over and above your standard deduction. So for married couples, that could be worth an extra $12,000 for a deduction. But there are some thresholds there as well. And this is also going to be tied to your modified adjusted gross income. So where it's at right now is it's going to be for single filers. If you're over $75,000, you're going to start to get phased out of the amount that you're going to get from that $6,000 deduction. And if you're over $175,000, it gets completely phased out and you just don't get it at all anymore. For married couples filing a joint tax return, that's going to be $150,000 is where it's going to start to become phased out, and it's going to go all the way up to $250,000. And if you're over the $250,000, you're not going to get any of that deduction. And what they're going to do is in between those thresholds amount, the amount of your deduction is going to be reduced by 6% for every dollar that you're over the amount of the threshold there. So that's how that works. So even if you're a little bit over, even if your income, let's say at single filer, even if you're $100,000 over that, you're $25,000 over the bracket. I think we did the math on the other video. You get about a $1,500 deduction or reduction in the amount that you're going to get. So instead of getting $6,000, you're only going to get $4,500. So again, one of those things that is going to potentially trigger from doing these Roth conversions. This next one is going to primarily affect people that are targeting some of those upper brackets as they're doing these Roth conversions because it's going to be at some higher income thresholds here, and it's the net investment income tax. This is something I've done other videos on in the past, and you may be familiar with this. It's something that was created back in, I think, 2008 or 2009, and it was part of the Affordable Care Act, and it's an extra 3.8% that could get assessed to your investment income. And it's meant to help cover some of the subsidies and some of the costs of that Affordable Care Act. And investment income includes pretty much everything. One thing it doesn't include is it doesn't affect or it's not going to be assessed on any monies that are coming out of an IRA account. That's going to be taxable ordinary income. So this net investment income tax won't affect your Roth conversion itself or the money that you may be taking out of an IRA account, either for living expenses or to cover the taxes on your Roth conversion. But like I said earlier in the video, a lot of people are getting money, maybe dividends or interest income, or maybe they're having to sell some securities to get the money to pay for these Roth conversions. It's definitely going to affect that. It's even going to affect other things like income you might get from passive businesses if you have anything that you're getting money from that you're not actively participating in, or even rental real estate income if you have any of that. So it's going to cover a pretty wide amount of that income. And this is something that was set when they originally created the net investment income tax, and it's never been adjusted for inflation. So it's for single tax filers set at $200,000, and married filing joint, it's going to be set at $250,000. So what that means is if your modified adjusted gross income is above those levels, you're going to have to pay potentially this 3.8% net investment income tax. And it's going to be assessed on the lesser of either the amount of investment income that you have or the amount that you exceed the threshold, whichever is smaller. But again, it's one of those things that as you're doing some of these Roth conversions and pushing your income up, it could definitely affect the amount of net investment income tax. So one of the things, as we're doing our financial planning and we're modeling some of these Roth conversions inside of our software, we're very detailed with how we put all of the investments into the account. And when we start modeling a Roth conversion, not only is it going to calculate the taxes on the conversion itself, but if the money to pay those taxes is potentially coming from one of those maybe capital gain situations where you have not only the capital gains, but it's pushing you up into this net investment income tax, it's actually going to calculate that for us. So it's going to give us a very accurate representation. You could certainly do this with pen and paper, but you want to know where you're at with those thresholds. And if this is something that you're exceeding that, an extra 3.8%, depending on how much you're pulling out, if you're pulling $50,000 or $100,000 out, it's something that goes into the equation. Again, for many of these things, it doesn't mean that you shouldn't do the Roth conversion anymore, but you don't want to get blindsided by that. And certainly if you're getting affected by any one of these items that we're talking about here today, it's something that will lessen the impact or the effectiveness of doing that Roth conversion. Okay, so this last one is going to be for those that are retiring early. And by early, I mean before 65, before Medicare kicks in. And if you're retiring before age 65 and you don't have health care coverage through your former employer or maybe a spouse that's still working, you're likely going to have to go out into the exchanges to get your health care coverage through the Affordable Care Act. And one of the things that we work on with a lot of our clients that are in this situation is we help them see if there's a possibility to qualify for an Affordable Care Act subsidy. And it can really significantly decrease the amount of money that you're paying for this. I think when we did the video a few months ago, we talked about these healthcare costs for a married couple that are 60 years old, let's say. It could easily be $24,000, $25,000, $26,000 a year for the coverage amount. And that doesn't even include all of the co-pays and all of the other out-of-pocket expenses here. So to be able to qualify for an Affordable Care Act subsidy can maybe bring that down by maybe, sometimes 60, 65% in some cases, depending on what kind of qualifications you have for getting those subsidies. Well, certainly doing these Roth conversions, in addition to maybe having to take other monies out just for your living expenses, that can very quickly get you above those thresholds. Well, as part of one of the bills that was passed during the COVID era, they actually extended the subsidies so that they're capped at 8.5% of your modified adjusted gross income. So even if you were over the thresholds, you could still, in many cases, still get a halfway decent subsidy. But beginning next year in 2026, they're going to return to what they used to do before, which is more of a cliff subsidy. In other words, if you're even just $1 over, you're not going to get any of that subsidy. And that's going to be tied to the federal poverty level. Again, I've got a deep dive video, and maybe I'll have Ethan, my video guy, put a link up here or over here, wherever he puts it, and you can check that out if you're in this situation here. But basically, where we're at right now is for single individuals that are in this Affordable Care Act subsidy era, there's going to be a $62,000 modified adjusted gross income threshold. And if you're a married couple and you're both going out into the exchanges, it's going to be at about $85,000. So again, if you're even $1 over, you're not going to get any subsidy. But if you're not, you can get a pretty significant savings in this Affordable Care Act. So that's something we map out. And again, one of the tools that we use is we use this eMoney advanced planning software to be able to map this all out. So we're looking at just not only what your taxes are, but how does that look with these Roth conversions? Is it triggering any of these other events that may cost more money in a different area? Or basically, how are you even taking money out to fund your retirement, and what does that look like, and what are the best accounts to withdraw from first? So anyway, that's it for this video. Hit that like and subscribe button, and if you've been struggling with putting together a plan for your retirement, maybe feeling overwhelmed by all of these different moving pieces, we have a great program. It's called the Retirement Time Machine, where we do a standalone financial plan that's not connected with where you choose to invest your money. So you might be investing somewhere else, you might be perfectly happy with that, but you've got a lot of these questions that you're trying to figure out answers for. Having a detailed plan for your retirement is, I think, the best way to really get that clarity and feel more confident about the decisions you're making about your retirement. So I'm Bill Leatherman, moneyevolution.com, and I'll see you back in one of our next videos. Thanks.